Looking ahead to PCE coming up, the estimates for 2.5%. If it comes in line, maybe even lower. I want to ask you, a lot of chatter about this at the New York Stock Exchange yesterday. Does that possibly make the July meeting a live one where we could possibly see a move?
I don't think that it will make the July meeting a live one where you could see a move. The Fed has said many times that it needs to have increased confidence. And so I think what will likely happen in July is they'll signal that they're achieving that increased confidence, thereby cementing the possibility of a September cut. So I don't think July becomes live. I think it is a transitional meeting where it's the communication that matters as opposed to the actual move in the Fed funds rate.
So yesterday, a lot of spirited discussion about that GDP report coming in much stronger than expected. I want to ask you, how does the Fed read that? And then also, how do they read the chain-weighted price index? Came in considerably lower than expected.
So look, I think they read the GDP as a good signal. The economy is clearly strong. It is withstanding these higher rates. It also is a signal that they don't have to move precipitously to cut. And that goes to your second question. There are some signs of weakness that are starting to emerge, chain-weighted numbers. Also, the labor market is clearly, getting back into balance, maybe moving a little bit to weakness. So I think they put all of this into a mix that says we are achieving, hopefully, what will be a soft landing. We can wait until September to cut. If that GDP number had come in dramatically weaker, that might have put July on the table. But I think that number simply gives them the confidence that the economy is not sinking. Consequently, they can wait for some more data and move, as probably most people expect, in September.
So you say they can wait for some more data. Consensus is that cut is coming up in September, as we mentioned earlier. In your mind, is there a risk that September may be too late, that the cooling of the economy may be going too far, and that we may just miss that so-called soft landing?
Well, this is why that most recent GDP reading is so important, because it does suggest that the economy is still holding up quite well, even as we see labor markets getting into balance and as we worry about, sort of other risks that are starting to emerge to the so-called dual mandate. And so I think the reason many of us who are expecting to cut don't see that in July, but do see it in September, is that, in fact, they're not confronting an economy that is falling precipitously and putting at risk what we hope to be a soft landing.
So, Roger, there's an elephant in the room, the huge changes when it comes to the presidential election. Is that something that the Fed is considering or weighing in any way when it comes to their decisions?
I doubt it. They have an obvious obligation to focus legally on their dual mandate. The history of the Fed shows that whenever someone at the Fed starts to become, overly involved in politics, they end up making, a wrong decision. Arthur Burns is not well regarded because he gave in to some pressure from the Nixon White House. So I think at this stage, the Fed wants to stay completely above the fray, wants to be able to justify its actions based on incoming data and a changed outlook, and not leave open the possibility that anyone thinks that they're being driven by politics in this particular year.